How to build your credit score fast in your 20s. Hey young adults! Have you ever tried to apply for a credit card, apartment, or even a car loan and been denied? Or maybe you've seen high interest rates and thought, why me? The truth is, your credit score is silently holding you back. But don't worry, you're not doomed. Today, I'll teach you how to build your credit score fast in your 20s with real actionable steps you can start today. And stick around because the last step is the one most people ignore, and it could cost you thousands over your lifetime. Step 1. Know your score. Before you can improve your credit, you need to know where you stand. Pull your credit report from one of the major bureaus, Experian, Equifax, or TransUnion. It's completely free once per year. Many young adults don't even know their score, which is like trying to navigate a road trip without a map. Check 3 things carefully: your current score, any negative marks, and your payment history. Are there late payments from years ago? Do you have accounts you forgot about? Sometimes, credit reports contain errors that can drag your score down unfairly. If you spot mistakes, dispute them immediately. Knowing your score isn't just about seeing a number, it's about understanding how lenders see you. Is your credit history thin, meaning you've hardly used any credit? Or is there a record of late payments? These details shape your roadmap. Treat this as your financial baseline. Once you know it, you can create a realistic, actionable plan. Tracking your score regularly also helps you stay motivated. Watch it climb as you pay bills on time, reduce debt, and take steps we'll talk about next. Even small improvements feel like wins and reinforce good financial habits. Step 2. Pay bills on time, every time. Paying your bills on time is the single most important factor in improving your credit score. On-time payments account for 35% of your credit score, which is huge. Missing even one payment can cost you 50 points or more, depending on your starting score. Automating your bills is a lifesaver. Set up autopay for your utilities, student loans, or credit cards. Even a small amount counts, and the consistency sends a signal to lenders. You are responsible and reliable. But what if you're worried about overdraft fees or insufficient funds? That's where planning meets action. Track due dates, maintain a small buffer in your account, and consider using alerts on your phone. Many banks and apps will notify you before payments are due. Also, don't underestimate paying more than the minimum. If you can, pay off your balances in full. This prevents interest from piling up, which indirectly helps you maintain a healthier credit profile. Remember, lenders love a borrower who can manage payments responsibly over time. Paying bills on time isn't just about improving your score, it's about developing discipline and financial confidence. When you see your score rise, it becomes a positive feedback loop, encouraging even better money habits. Step 3. Keep credit utilization low. Credit utilization refers to how much of your available credit you're using. Lenders view high utilization as risky behavior, even if you pay everything off on time. A good rule of thumb is to keep it under 30% of your total credit limit. Example, if you have a $1,000 credit limit, try not to carry more than $300 on your card. If possible, aim for 10 to 20% utilization for optimal results. Paying off your balances multiple times per month instead of waiting for the statement due date can help you stay under this threshold. Many young adults make the mistake of maxing out their credit cards for convenience. Even if you pay them off immediately, the high balance might show up on your statement, temporarily hurting your score. Spread out your spending and pay as you go. Credit utilization is like a trust score with lenders. Can I handle credit responsibly? The lower your utilization, the more lenders trust you, which translates into higher scores and better interest rates. Over time, this strategy alone can boost your score 50 to 100 points in months without taking on new debt. Step 4. Become an authorized user. Here's a fast-track strategy. Become an authorized user on someone else's credit card, like a parent or trusted relative with a strong credit history. You don't spend the money, but their positive payment history is reflected on your report. This method works because credit history length and payment history are major factors in your score. By piggybacking on someone else's responsible use, you gain the benefit of years of solid credit activity instantly. But choose carefully. Pick someone who never misses payments and maintains low credit utilization. If their account becomes delinquent, it could actually hurt your score. Becoming an authorized user is particularly effective for young adults who haven't had much credit yet. It adds age and stability to your credit history, which helps you qualify for loans, higher credit limits, and lower interest rates sooner than starting from scratch. Step 5. Mix your credit types. Lenders like to see that you can handle different types of credit. This is called your credit mix, and it counts for about 10% of your score. If you only have a credit card, consider adding a small personal loan, student loan, or even a car loan. The goal isn't to take on debt recklessly. It's to show that you can manage multiple financial responsibilities. If you already have a card, a small installment loan can diversify your profile. The key is on-time payments and responsible use. A diverse credit mix signals to lenders that you're low risk, which can improve your credit score over time. Keep balances low and payments consistent. Over time, your score benefits from a combination of credit history length, utilization, and diversity, helping you qualify for bigger loans in the future. Step 6. Avoid hard inquiries. Every time you apply for new credit, it triggers a hard inquiry, which can temporarily lower your score. Multiple hard inquiries in a short period can make lenders think you're desperate for credit, which is risky. Plan your applications carefully. Only apply for credit when necessary, like when you need a loan or want a card with better terms. Soft inquiries, like checking your score online, don't affect your credit. Avoiding unnecessary hard pulls prevents your score from dipping and gives your other strategies, like low utilization and on-time payments, time to take effect. Think of this as credit hygiene. Don't open doors you don't intend to walk through. Step 7. Monitor progress. Finally, track your progress monthly. Set a credit check day each month to review your report and watch your score climb. Celebrate milestones and correct any errors immediately. Monitoring progress keeps you accountable and motivated. You'll notice patterns. Maybe one category needs improvement or a bill was missed. Early detection prevents long-term damage. Remember, building credit isn't magic. It's consistent, responsible action. Treat it like a fitness journey. Small daily actions lead to long-term results. So there you have it, 7 detailed steps to build your credit score fast in your 20s. Start today. Know your score, pay on time, keep utilization low, become an authorized user, diversify your credit, avoid hard inquiries, and track your progress. Smash that like button, subscribe, and comment your current credit score or which step you're starting today. Your financial freedom depends on the habits you form now, not later. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Always do your own research or consult a licensed financial advisor before making decisions.